business partnerships even survive past 1, 2, 3 years. And you guys have been in business together for 20 plus. Like, how?
The worst we can do out the gate is down 15%. That's the most that can happen.
And we handle an extremely volatile asset class. I mean, it's not even fair to call it volatile. If you're comparing it to a stock, it moves orders of magnitude faster.
Larry Kriesmer and Bernard Surofsky, partners for over 20 years, managing $570 million. This is how you win by mathematical design.
So my dad's early retirement and really significant financial windfall from working all those years overseas was lost. That process, frankly, destroyed him. We can custom design in the SMA space a structure and a strategy that would, blow your mind if your capacity for risk is.
I'm Garrett Wong, and this is the Investing to Win podcast. How do you define success, and what does winning look like for you? Larry, Bernard, thanks for coming on my show today.
Thanks for having us, Garrett.
Yeah, so audience, we actually have not one but two guests here. Joking around in the green room, it's I think it's going to be a very enjoyable podcast episode. But why don't we start with each of you sort of giving us a bit of a background on yourselves and a little bit of an intro, if you will, and how you came to be today.
Okay, I'll go first on this one. I grew up in South Africa, graduated college there with a degree in construction management and economics. Came to America in my late 20s. Pretty soon got started off in the insurance industry. I wanted to always be involved in financial services. So the financials, started off with a company called Mass Mutual. Met Larry at Mass Mutual. We decided to partner up, and we've been partnered now for, more than 20 plus years. So there's something to be said for that. But, it's interesting. Both Larry and I grew up in foreign countries. So I think we bring a unique perspective to how we do things. So anyway, I'll let Larry give his piece.
Sure.
Yep, I was born and raised in Saudi Arabia, in Dhahran, Saudi Arabia, and that's on the heels of my father going over in the 40s, my grandfather going over in the 30s, and then bringing his daughter, which ended up being my mom. My mom and dad met in Saudi Arabia and raised their families there. And so, again, as Bernard said, maybe a different approach, looking at the world differently. All the kids in Aramco, the oil company that I was raised on and in, all went to boarding school. So everybody was prepped to leave home at age 16. And that's sort of my background history. And then I got to the US, I got an English writing degree and a broadcast minor, which is interesting. So this is something I enjoy doing, but a personal part for me is I love tinkering with stuff. I love fixing things. I'm very prone to not wanting to throw anything out. Almost anything. I'm that guy on the Instagram reel that'll save a little piece of foam from the corner of the shipping package because I think I can probably use that at some point in the future. Yeah, that's really how I think. Yeah, exactly. So it was years and years ago that Bernard and I first sort of ran into the financial problem of diversification and the lack of help therein. And it was that inner quest for me to always try and find some kind of solution to a problem. And that's what led us to Measured Risk Portfolios, the firm that we currently manage.
Okay. So Bernard, you started off in financial as well, though?
Well, back in South Africa, I was actually doing construction. I was more on the construction side. Okay. And I had my degree with the economics focus as well. And when I came to America, I decided to go more on the financial side and less on the construction side. In fact, entirely on the financial side.
Yeah, I love, as I said in the green room, I just love hearing about origin stories, and that's kind of where this podcast has evolved. Larry, you said like English and broadcasting. I have a science background, a master's degree in molecular biology, and yet I'm in real estate and property management. What made you take the pivot, and when did that happen? Was it obviously after America? But
yeah, that's actually a weird, kind of strange story. My father's an engineer. Bernard will tell you, I'm very much a structured kind of thinker.
Yes.
And I remember going through high school with very much an engineering focus and math focus and doing really well and having a very high GPA in that space. And over the summer, when I was between 18 and 19, getting between high school and college, something literally changed in my brain, and that math skill literally went away. And I struggled really hard in college. And that's not because I got to college, because frankly, I'd already been in boarding school, which is, you already got the governor was taken off when I went to boarding school. So it wasn't anything like that. It was just literally not being able to read my own handwriting in financial notes that I'd written in my senior year in high school, that I didn't understand what I'd written when I got to college. So I had to pivot out of that because I wasn't making it in the curriculum. But it didn't go away. And I think what ended up happening is I enhanced the creative thinking part of my brain during that, maybe the latter part of growing up. And when I've always been entrepreneurial and like trying to make 1+1 equal 2.5 or 3 instead of the straight math. So I'm always been that way. And to me, graduating from college with an English writing degree was not going to be my ticket to success. It was just getting my degree and learning how to learn, more than using that end piece of paper as my career. So it was going to be something. I actually, at the same time, I was looking at financial services and life insurance. I already had taken my realtor's exam and had gotten passed, and I could not find a single realtor or firm in San Diego in 1985 that would bring on a fresh young face. That was a time period in real estate that things were going a downturn, and it was just crickets, multiple resumes. And back then there was no internet, so it was all just long form writing people, and very difficult. And meanwhile, the life insurance industry would pretty much hire anybody who could fog a mirror, and show up with the ability to dial a phone. So that's where I ended up going. So that's the sort of the short version of how I arrived at financial services. But,
Oh, wow. And Bernard, you said construction. What was that pivot for you to pursue the other side of it?
Yeah, so when I'd always been interested in stocks and investing and all that good stuff. And when I came to the States, I started off doing, very, very light construction, like more handyman stuff, just to get by. And I had a cousin of mine who was in the financial services, and I said to him, "Hey, Bob, I'm interested in doing this." And so I'm one of the few people that ever called up an insurance company and said, "Hey, I want to come and work for you." So they spent tens of thousands or even hundreds of thousands of dollars per year recruiting people, and I just knocked on the door, and which it was a pretty funny interview. I showed up in a jacket that I think my sleeves were like down to there type of thing. I hadn't worn a jacket in some. This is the only jacket I had, and the guy who hired me said, "We'll hire you as long as you get a new jacket."
Oh, wow.
Okay, I mean, I can do that. So, and that was the very beginning of the journey into the financial services industry. So, then it's been quite a wonderful journey, and largely thanks to Larry.
Okay, so you said you guys met at which company then together?
That was at Mass Mutual. Yeah.
Mass Mutual. Okay. So I mean, I think there's some stat out there that says I don't know, 1% or 0.1%. I can't. It's very, very low. And you know where
Correct.
I'm going with this.
Correct.
Business partnerships even survive past 1, 2, 3 years.
Yeah.
And you guys have been in business together for 20.
20 plus. Yeah.
20 plus. Like how? Like what is the glue?
Very carefully.
Yeah, I think the great part about this is that neither one of us really struggles for this part. There's a really tremendous amount of respect for each other's opinion, and that we recognize that there are skill sets that each of us are lacking that the other has. But I think probably the biggest component is, how can I say this, forgiveness, that it's okay to not be correct. And we're really clear that we're not correct. We're just doing our best, and we
Correct.
are going to make mistakes. And when we make those mistakes, we want each of us to learn from them, not just one of us to learn from them. So I think that's a big part of it.
Well, and I think another big part of it is that nothing happens unless we both agree on it. So, if you're going to make a big decision, we both have to agree on it, which means we each have veto rights, but we also have the ability to try and so-called petition the other person to, I really think we should do this. And let's say Larry thinks I really think we should do this. And I go, I'm totally opposed. Well, he says, well, here's why. It's incumbent upon me to listen. And then I've got to explain to him why I think it's either he convinces me or he doesn't. And if I don't, If he doesn't, then the default is we're not doing it. That's also been a very big component for, and it's again not right or wrong. It's again we both know that our hearts are in the right place. I'm not doing something to try and make sure that Larry's going to get hurt, and he's not doing something to make sure I'm going to get hurt. There's none of that. We're in this together. We both have each other's best interest, and of course the firm's best interest, but most importantly, our client's best interests at heart. That is paramount. That rises above everything. But it's that ability to, we both have to agree. I think is also critical, and the fact that we do have, different skill sets, I think really helps a lot as well.
Yeah, I would agree. I mean, I've had several failed partnerships. You can almost say I'm almost anti-partner by now, and a lot of that sometimes comes from the disparity, or maybe the illusion, like perception. You know what they say. Obviously, the two of you not only care and communicate well, but it's also the perception that each of you are working as hard as the other. Would you agree with that?
Yeah, I mean, absolutely. We have a unified, there's a unified objective to what we're doing. So, 100%, yeah.
Yeah, well, that's amazing. Well, walk me through what the organization looks like today, and then we'll kind of dig into the little unique things that brought you to me.
Larry,
we have two handsome partners. That's, for people that are just listening, you're missing the best part of this.
Yeah, you guys are. You got to go to my YouTube channel.
There you go.
Right. Nothing but confidence coming from the top. That's for sure.
That's right.
We have a team now of 11 people in the company, including ourselves. And the biggest growth that we're experiencing right now is in the sales and marketing component. I think you alluded to the idea that I think so. We have this publicly traded ETF that we manage now that was just launched in March of 25. And that is driving a significant amount of our current growth in our assets under management. We have a sales office that we're opening in New York. That's actually been signed and will be open in a couple weeks. So we'll have a second location to staff and to house the people there. So we'll have offices in New York and in San Diego, here in California, for our home office. But a lot of our staff is remote. We have people that I think part of COVID allowed us to realize that we can pick from the best of people, not necessarily the best that are within driving distance. And so our top admin was someone that worked for us briefly and was then poached by a big firm with 3 letters that I won't mention by name. But we kept in touch with her over the years. And when COVID rolled around, I just reached out and said, "Hey, what are you doing?" And she was available, and we picked her up because she was no longer living, near our office, but it was no longer a factor. So we have people now that have been working in Nevada and Arizona and New York, and we're not opposed to bringing on the best talent anywhere we can find it. And that's kind of our mantra now.
Yeah, I think remote help is, boy, is that ever a hot button topic these days? Many big, huge firms are calling people back to work, and I think, I mean, myself included, property management is no stranger to challenges in remote help. Do you guys think that your success with remote help is related to the fact that you guys are in financial services, and maybe it I don't know, I don't want to say attracts a different type of mindset, but maybe the type of work aligns itself with somebody who can work independently without supervision, without having to be micromanaged? I don't know what I'm looking for here.
I don't think so. Because I think it's more about the expectations of the business owners with respect to the people who are working remote. And I think back to probably the week before COVID hit. I'm talking about like January or December of the year before, and Larry was saying, he's thinking about hiring somebody remote, and I was like, no way, we can't do that. We need people here. I want to hear what they're saying. If they're having any kind of problem, I want to be a part of it. I want to be able to be on top of stuff. And I was completely opposed to the whole notion of it. And of course, COVID hit, and yeah, I'm on board. Remote it is, Right. So, but I think it's about being able to clearly communicate the expectation of the work that needs to get done, getting done, and whether it's getting done by somebody sitting, 4 feet behind me, or if it's getting done by somebody sitting, halfway across the country. it's getting done. And I think it's important to try and create a culture of, you know, I use the word family, but I'm trying to think not of a dysfunctional family. I'm trying to think of a more of a kind of cooperative family where, again, you want to be sure that the people have the same intent of, let's take care of the clients, number one, but let's get, we have to get the job done. And if you're going to work a couple hours more or a couple hours less, we're not there to micromanage you, but please make sure that what needs to get done today gets done today. So I don't think it lends itself only to the financial services. I could see it happening, being applicable in many different industries. I don't think it's unique to financial services.
Okay.
Yeah. I would say there's a point with remote office that we picked up from an admin that had worked for us for 15 years and then chose to follow a passion involving training animals, dogs specifically with behavioral problems. But she was with us during COVID, and she was the one who instituted something that we can now call around the water cooler, which has still survived 5 years later. And every week, without fail, on Wednesdays at 10 o'clock, we take an hour off as a company and we jump on a Zoom call or a Teams call. And there's no work discussed. It's just what you do on the weekend, anything interesting coming up, anything you want to share, pictures, songs, a fish somebody caught, whatever it is that isn't work that you're free to talk about or not. You're not compelled to do anything. And that, I think, that cultural piece helps a lot because there is, this team building concept that happens in a physical office that just happens organically. We have to kind of foster it and enforce it a little bit. And sometimes I can tell from the facial expressions that people do not want to be on that call because they've got something important for work to do, which is great. It's also great to see. And it's great for the rest of the team to notice that, well, that person is here for us, but really wants to go do the thing for the job, right? So that's all good stuff. And then we have a culture of understanding that people are not perfect. They're going to have mistakes. And that if you make a mistake, your first thing to do is to raise your hand and say, we got a problem. And let not just your team person know, but the company needs to know that something has gone wrong or that some procedure wasn't adequate to prevent it from happening so that we can all learn from it. And that we want to just make a mistake once, not repeat it, right? So we know it's going to happen, but let's just try and figure out the best way to never have it happen again. So those two things, again, still primary taking care of the client, but also fostering some sort of internal family style culture, I think really helps keep this remote workforce working as a team.
Yeah, I mean, we do something similar at my firm. Not every week. I mean, we do meet every morning, but that's more just for metrics and KPIs and things like that. And then every quarter, depending what theme it could be, like we had a Halloween party, and obviously we get together for Christmas and Secret Santa and the whole 9 yards. And kind of, I don't really subscribe to the adage that, you have a work function after work. So I kind of pay them, shut down the office. Everybody gets, skip the dishes or Uber Eats or whatever. And then we have a meal together. And then my social committee kind of plans online games, right? And it's like super cringy for everybody. But by the end, I mean, but no, I mean, you're right. You do have to force it because engaged staff is kind of that, one of the pillars of that three-legged stool that you need to be able to build the foundation of a great company. So yeah, it sounds like you guys have unlocked that. I like that weekly virtual lunch, though. I might steal a page from that.
Go for it.
Yeah. So 400 million assets under management, and then synth equity. Let's unpack that a little bit. What exactly is it, and what prompted you to actually create a public ETF?
You go, Bernard.
Okay. Well, firstly, I'm happy to report that the AUM we've actually crossed over 570 million.
All right. So I hold info. That's awesome.
That's okay. It's moving right along, as we like to say.
It's not going down.
Exactly. Well, 100%. The idea for launching a publicly traded instrument is when you're dealing with us, there's a thing called an SMA, which stands for separately managed account. So prior to having a publicly listed instrument, you either had to come to us and open up an account with us, or if you were another financial advisor, you would have to have a formal relationship with us. And there's just a lot of paperwork involved in what's called the SMA, again, the separately managed account. And one of the challenges our sales guy was having was just, getting people to go through all of the approvals and paperwork, which was, there's stuff. I can't stand you today and tell you, oh, there's not much to it. There's definitely stuff. But by launching a publicly traded instrument, suddenly the whole world becomes available to invest in our product as long as it's approved by their home office if it needs that, or if you're just a guy on the street, you can go out there tomorrow and buy our ETF. So distribution was really our primary focus on trying to get this out there, and it's far exceeded our most optimistic expectations have been very well exceeded. So it's been a very, very satisfying experience thus far.
Okay, so that's basically the gap in the market. What are the specifics of trying? I mean, is it difficult? Is there a reason why you don't hear about a lot of firms doing that?
Yeah, I think the primary thing is it is a few $100,000 to launch an ETF, just in sunk operational costs that you won't get back. That's not recoverable. And then it's a tremendous amount of ongoing capital. So something like $200,000 to $300,000 is typically, if you're doing an outsourced version, which pretty much you can't be a firm that doesn't have a risk management program or an independent trustee program or a derivatives risk management program. All the structure of that is pretty intense for a startup to have and to have staff, because it's not a full-time role. So you'd have to find somebody who just wants to do work for you for 4 hours a quarter. It's really not feasible, right? So if you're going to use a third party to start, which is what we did, then that overhead is pretty significant. And when you start with no dollars. And so your management fee, your unifying fee that's coming off of those assets under management on the first $1 million might only be $10,000. And that's $10,000 per year. So you're picking up like, $800 a month. Your carry cost is something like $20,000 to $30,000 a month. So you have to get to scale, which means you need to hit something like $25 to $30 million of new money, new capital, not money that you would cannibalize from your existing clients' assets, or make sense to move over, but new capital to be able to absorb that expense, or have that kind of ability to invest that kind of capital on a structure that you're not sure will actually raise any money. Because people will tell you they're going to put $5 million into this idea if you list it as an ETF, and they don't have to sign a contract. They can just tell you, right? And because they can just tell you, they don't have any compelling reason to follow through. So a lot of our hesitancy was just the idea that it has been very difficult to raise capital in the SMA space because of what Bernard mentioned. Paperwork is intense. We have to get clients to sign off on margin agreements and on option approvals. Those option approvals can sometimes be challenging to get for certain clients. All of that goes away and becomes just a 4-letter symbol that an advisor or a client can type into their part of their computer monitor and tell us the number of shares and hit buy, and it happens. So it's lowered the entry tremendously, both for account minimum size. At this point now, you can invest like $31 into our strategy. That's what the share price is roughly. As before, it was basically about a $250,000 minimum on the SMA with us, and maybe as low as $50,000 for certain arrangements with certain clients. So it's all become much easier with the ETF.
Yeah, I mean, what immediately comes to mind, and maybe you can clarify this for not only myself but the audience, is when you're dealing with your typical SMAs, I imagine the word accredited investor kind of peeks its head into the conversation, or not. Like, I don't know. Are you guys not regulated in that way, the way we are in real estate?
No, it's because we're dealing with a liquid asset that is traded on the exchanges. There isn't a requirement for an accredited investor.
I didn't mean the ETF. I meant your.
Yeah, that's what I mean.
Yep.
The
SMA, correct?
Oh,
yep.
the SMA also.
Yeah.
Okay.
Correct.
Yeah.
Correct.
Yeah, the SMA it is more difficult to onboard, but it has more blades in the Swiss Army knife. So the ETF is doing a great job, but it can't granularly adjust the risk component for the end investor. It is caked into one risk sleeve, and you either like that sleeve or you don't. So either invest in it or you don't invest in it. With the SMA, we have the ability to, on a bespoke custom basis, dial up or down the amount of risk you're taking in the same strategy, but just more or less potential drawdown, and as a result, more or less potential performance. and that can't be accomplished any other way than through the SMA.
Okay. Yeah, but in the ETF space, like you said, $31 share price barrier to entry is very, very low.
Right.
Correct.
In terms of, I mean, there must be a volume play there too. How is that impacted, and does it factor into your overhead?
Well, I'm not sure that there's not a volume issue. I mean,
Because
there
people
is.
are just buying stocks and it's on the open market, right? It's not like you have to
Yes,
process
you don't
anything.
get a better price if you buy one share than if you buy 1,000 shares, or that if you buy 5,000 shares. So that's not the issue. The price is going to be between a bid and ask that the market makers establish based on the holdings of our fund, and you're gonna pay somewhere in the middle there. That's the way that the market works. There isn't a volume discount to speak of.
I think, sorry, to correct myself, clarify, what I was referring to is just the amount of paperwork managing an ETF versus the SMA, and maybe somebody investing $250,000, like Bernard's point, the paperwork and things like that. How much
Right.
paperwork is there involved now that the ETF is up and running?
Yeah, there's a significant amount of compliance component to the ETF and operating the ETF, but there is virtually none between the end investor and the ETF, other than the distribution of the electronic prospectus that most custodians will provide, either concurrent with a purchase or if an advisor provides it in advance of the purchase. So that part of it is almost very, very limited
Right.
from a practical perspective. But from our perspective, managing the ETF, we have significant oversight from our partners. Title, who's the primary advisor, we're the sub advisor, lead sub advisor on the strategy, and we have a quarterly responsibility to report everything. So there's a ton of compliance in the operation of the fund itself.
Okay. And so the fund, I mean, in 2025, there's lots going on. Elections, AI, there's lots of disruption. How does synth equity kind of help investors stay calm and confident?
Yeah, that's a great question. The beauty of what we've created, and I think what sets us apart from everybody else, is we have a floor on the downside of how much can be lost over the looking forward basis. It'll be up to a 12-month period where we can tell you categorically how much you can lose in the fund, net and gross. So meaning the worst we can do out the gate is down 15%. That's the most that can happen. But over the course of that year, it's going to be adjusted to about down 12.5% because the bonds are earning some interest. So to have an investment that you can go into knowing that your downside cannot exceed a predetermined number, we just think is such an incredible way to bring peace and comfort to an investor about what the worst case scenario looks like. Now, you might think that because you know what the downside is limited, that you might have a limited upside. We're unlimited on the upside. So it's this asymmetric relationship between risk and reward where we've said we want to have unlimited upside and limited downside. And it's a whole different way of thinking about investing. And thankfully, we've done anybody's free to go see what we've done. And so far this year, it's definitely, we have delivered, and we expect to continue to deliver. The beauty of that peace of mind, that's when, that's what Larry and I were always in pursuit of. When we first when we first partnered up, we were trying to think about a way to design a portfolio where you could tell a client you can't lose more than this amount. And initially we had people signing NDAs with us because of how we built the portfolio. And we would commit to not losing more than 10% or 15%. And those are the kinds of numbers we committed to. And we built out the structure, and it delivered. 2008, which was a baptism by fire for us because we started this idea in 2007 as an SMA, and of course 2008 comes around, and we, wow, that's all I can say.
Don't invest in real estate, yeah.
Talk about a smack on the head, but except we delivered. We were down on average less than 10% as promised, and of course then we had to now rebuild everything, which wasn't that difficult because if you understand sequence of returns, if you're down 10%, you've only got to go up 11. That's not terrible. So by the middle of June of the following year, we were beyond break even for our clients because we were able to limit our drawdown to such a small number. Whereas if you were in the S&P 500, I think it took, 5 years to get back to break even? It was just a grind. So by limiting your losses, you don't need to be as aggressive on the upside. And when you look at that sequence of returns thinking, it is a magnificent thing. So you talk about, now we're living in a stage of AI and all these other wonderful things going on, crypto, all those types of things. But look, back in 2000, it was all about, the internet and, but then that bubble burst and that wasn't so nice. And then we had the financial crisis in 2008. And again, that wasn't so nice. And then, of course, we had COVID in the early 2020s. These are not nice events, and they're oftentimes reasons for people to not even invest. Our philosophy is you have to invest, you have to stay invested, but you got to pay attention to what you can lose. If you can keep that to a minimum and you can have unlimited upside, good things will follow. It's just sequence of returns. It's pure mathematics, something that Larry alluded to that he lost sight of in his later youth. But he's come to his senses in a very meaningful way. And it's something that people don't appreciate. Like, if you lose 50%, you've got to go up 100. That doesn't happen very often. The S&P doesn't often go up 100.
And I'm just going to stop for a second because you really have to let that sink in. We gloss over it as advisors. And I think if you put it in dollar terms, that if you start with $100,000 and let's just say you're successful and you grow it to $200,000, you've doubled your money. That's 100% return, but it only takes a 50% loss to give it all back. Mm-hmm. That is something you really have to pause and think about, because the effect of losses is so much worse. And it's because, again, this is this like math savant side of me saying the losses by definition always occur on a bigger number because you're taking the bigger number and reducing it. Gains always start on the smaller number and lift it. And that lift is harder than the drop. So our goal really is fundamentally to try and keep losses, mitigate them. We can't eliminate them, but what we're trying to do is help advisors and investors decide what is their survivable loss limit. Like, what is the amount of pain you can tolerate that won't make you drop this investment for something else that's shiny, that's floating down the river next to you? Because ultimately, that will lead to success, far greater success, I think, than the timing of stock selection or the stock selection itself. So our focus is trying to keep that loss level to something that you can rebound out of within a reasonably short amount of time. And we found that basically that number to us is about 15%. And the reason that number is that the stock market, the S&P 500, the large benchmark that we tie our investments to, has historically been able to recover, generate a return of something like 15 to 18% more often. That is the most common. More than 50% of the iterations of the year are over 15% in the S&P 500. So if you've limited your losses to 15, it does take about 18, I think, or 19% to get out of a 15% hole. But you've gotten yourself very close to being able to get back into forward progress within 1 year. Now, once you start to let those losses get to 20 or 30 or 30 or worse, 40 or 50%, you're now almost assuring yourself of a multi-year recovery period, where the best you're going to do is get back to where you were. And the time is what we can't get back for our investors. No one can rewind the clock. So I'm confident no matter how deep a hole you get yourself into, as long as you still have capital left, you'll eventually be able to earn your way back to something, but you'll never get the time back. And that's a huge impact for us.
Right. So, Bernard said it almost like he was clearing his throat back in 2007, 2008. Oh yeah, we limited losses compared to, the S&P 500. I mean, that's incredible, right? I mean, let's emphasize that, because I don't think there's many people, firms that could say that, right? And was that just this principle of this 15% floor? I mean, it sounds so simple.
Yeah. At that time, it was bespoke. So we had discovered that we could buy options that would move dramatically stronger than the market movement. So ideally, what we're looking for now is an option contract that will respond at about 10 times the pace of the market on a daily basis, right? So if the market's up 1%, we really want our options to move 10% up. And that allows us to only have a 10% allocation in the whole portfolio. And that 10% allocation would be sufficient to keep up with the underlying index. And it works both ways. If the market goes down 1%, we expect that option contract to lose 10%. And in so doing, it only has now 90% of its value left. And so the next 1% move down shouldn't be as strong, and the next 1% down should be even softer. So these options have a phenomenal mathematical thing where they soften participation on the way down and they accelerate participation on the way up. This is just a mathematical observation that is factual. And we use that to our advantage to harvest gains when the market is rising, to sort of keep the risk balance in check. This is unique to our firm, I believe. And we then use those profits. We'll buy additional treasuries, additional bonds to raise the safe balance behind us, because we know a drubbing, is coming. We just don't know when or how severe. So to us, the idea is that rather than holding a long-term position, we're just scalping small amounts of profits as often as we can and adding to our treasury balance and giving ourselves plenty of time in the future, up to a year, for the options to have time to go through a dip and potentially recover before we have to potentially sell treasuries and re-risk the portfolio if we have a full 1-year term with no performance.
Mm-hmm. Mm-hmm. On my side of the table here, guys, you sound extraordinarily conservative, and yet you're doing really, really well for your clients. One thing of the research that I did on your firm is that, a lot of investors are told to try to beat the market, get in, get out, that type of thing. And yet you've built this strategy for staying in it. Maybe unpack that, especially now, with all the volatility that people are seeing.
Yeah, it's great. Great. Again, I love that question because I have a story to tell, and Larry might tune out here because he's heard the story more times than I care to remember. But it was around October of, I believe it was 2011, and at that point it was SMAs, and I get a call from a client's wife. Now, again, it's not that I don't hear from the wives that often, but in this particular situation, I'd met her a couple of times, but she wasn't the primary point of contact. Her husband was, and I actually thought initially that he had died. Like it was like, oh my gosh, like it was that unusual for me to hear from her. And when she mentioned that, she and her husband were having trouble sleeping at night, I felt, okay, a great sense of relief. Okay, he's not dead. Good. What's the problem? And she proceeds to tell me, we've got the fiscal cliff, the debt ceiling. There's an election coming up in the not too distant future. We're very nervous that we're going to lose all of our money. We want to be sure that we're doing okay. I need to be calmed down here. I'm like, okay. So I had to log onto her account, and because it's an SMA, she can log onto her account, and I can show her what she has. And I went through not that many positions. I think there was 6 or 7 positions. There's 4 government bonds, and of course there were the 2 options. And at that point, the account was worth about $750,000. The bonds were worth $735,000 of that. The options had a remaining value of about $15,000. We were down, I think, about $60,000 or so on the options already. And I went through each piece with her, and I said, these options could go away. There was roughly $15,000 remaining. These bonds, fiscal cliff, debt ceiling, let me take a 1% haircut on that because I didn't figure that they were going to default, but I just figured for the sake of clarity. So I said, if I were to do all of the math, looks to me like you got maybe $22,000 at risk if I were to take a worst case scenario. To which I got back the sweet sound of silence. And, silence is never a good thing because, what is somebody thinking? And so I go, ma'am, are you still there? And she goes, Bernard, I had no idea you were taking such good care of us. I will never bother you again. And I was left speechless. I was like, wow. But what it did for me, it instilled in me that desire to have other people experience what I'd experienced, be they advisors or be they individual investors, that sense of calmness. When you look at what you have, you actually focus on what you have in your account, and you can do the calculation to figure out that this is how much risk I have. So in her mind, she was going to lose, $750,000 or give or take, when in reality, she had $20,000, $23,000 that was actually at risk. So obviously, I was able to keep her in the market. The market's recovered. We ended up having a decent year. I haven't heard from her again on that type of a topic. I have spoken to her again. But when it comes to investment stuff, it's just, there's no sense of nervousness or anything. And I've just stuck with it. We've stuck with the same basic premise, which is predictability of outcome on the in the worst case scenario. Let the upside take care of itself. We're not trying to be market timers, which personally I think is just folly. Nobody knows. I mean, I always joke with people, tell me when the market will open tomorrow and tell me where it'll close tomorrow. I can play that game with anybody, any time of the day or night, because nobody knows what's going to happen in the next 5 minutes. You mentioned the term volatility. And obviously, if a leader of some country comes out and makes some comment that is either interpreted as positive or negative, the markets react immediately. You don't have time to think, let me see what I'm going to do here. That is just nonsense. And just somehow or another, you have a timing model that can, based on volume of this or some indicator over there, is going to give you a full warning of what's coming. It won't. And
I'll add one thing, and that is that one of Bernard's pet peeves really, really fries him. And we've been in this business now long enough to witness this over and over and over again, is that when there is a crisis of some kind, the thing that advisors and clients have been looking for didn't exist, but it gets built. It gets
Right.
built after we needed it. And it then gets added to back-tested models and gets published as a way that we could have had this outcome had we had this thing we didn't have
Armchair
available.
quarterback, yeah.
Right.
Oh my God, it's brutal.
Ah.
And so the idea that we're not back tested, we are math tested. We have a
Logic
factual
analysis, yeah.
knowledge in advance to know that so long as treasuries don't default, which I have to say from a compliance perspective, there is always a chance that could happen. It is a very faint chance, but it's not zero. So that there is still a risk component even to treasuries, but we do our best to mitigate that by having the shortest of durations. We have a rolling 90-day quarterly maturities on a 1-year duration. So we're holding 6-month average maturity treasuries, and 25% of that holding is coming due every 90 days to reinvest into the next 1-year period. So really, we're not asking the treasuries to do anything other than not lose money. That's the expectation. So our biggest year ever that we've experienced, well, almost nearly 40% return net of our fee, was in 2019 when the bond ballast was yielding less than 1.5%. So it's not dependent on the bonds. That's not doing the lift. All of the option engine is all the return is derived by the options. And since we then have to get people to realize that we are openly, willingly allocating a pretty healthy risk sleeve into an asset that can actually go to zero. And it's not an asset that we can hold to recovery. It's an asset that will essentially vaporize and become worthless, that we have to then sell the treasuries and buy more of. That, I think, is the big, wow, that's something to digest and just be clear that we are actively buying something that can lose 100% of its value. Now, I say that with pride because a lot of other portfolios are built on the idea that they're investing, say, $100 or $500 into something that they hope won't lose more than 50%, or that they hope won't lose more than 35%, because that's historically as much as it's lost before. Bernard and I both find that to be a foolish hope, and that all that's telling us is that's what's occurred in the past. It has nothing to say about what could happen in the future, given some unknown future event. I'd like to think that our portfolio is resilient to whatever occurs. None of us can predict the flavor of the next crisis or what's going to cause, a sudden 30 or 40% one day or 1 week or 1 month decline in the assets that we own. But I'm very confident that our portfolio won't suffer that type of severe drawdown, given whatever that thing is that's happening. So that's really at the base of it, is that I am here to tell you I am exuding confidence in the structure, right, that the structure is going to be resilient to whatever comes along the line. Then I'm also a huge fan of the S&P 500 and basically of American financial companies, not financial companies, but companies in America that are publicly traded. If you look at the distribution history on the S&P 500, the number of incidences where you get 15 and 20 and even 25% annual returns is significant. The annualized average return, though, has to take into account that every once in a while we get a negative 30% or even a negative 40%. And that's why we don't allocate a significant amount of capital to that asset class, because we can't afford to take the risk. So what if I told you there is a way to structurally mitigate the amount of downstroke, but still keep all of the access to the upstroke? Holy smokes. Do you think that might tilt the rate of return long term in your favor?
Mm-hmm.
It absolutely. It absolutely has that capacity. It doesn't mean that it will. And we can still have losses. I'm not in control of the outcome. I'm not picking stocks, one by one. We are just saying that the long-term engine, that S&P 500, is a tremendous vehicle for long-term capital growth. You just have to stay in it. And so this is a way to synthetically get access to it without being exposed to that potentially near retirement type of thing where you don't have 33 years to go to recover. And this allows you to keep your allocation, hot without taking the risk of that big severe smack in the head, which may never come again. Maybe we never get another 40% drawdown. But as long as we think it might, we're foolish to not plan for it.
I sit here listening, not watching, but listening to the two of you. And I think what comes across, other than being handsome, but no, in all seriousness, it's the two of you are genuine, analytical. I don't detect an air of any kind of salesmanship here, right? It's all sort of left brain type stuff, right? And I wanted to touch on something Bernard said, because I think in your industry, like any industry where you're dealing with assets under management, mine included, trust, right, is a huge factor. Did you find, I mean, this is going to be a multi-part question, but just the fact that you have a publicly traded ETF, what has that done for credibility to your firm? Just that fact alone.
Oh, yeah, no, it's enormous. It's enormous. I don't know how else to to describe that. Not only are we publicly traded, but both Larry and I, we've had the unique opportunity of having what I would probably refer to as both the most exhilarating and humbling experience of our lives, which was ringing the bell, the closing bell at the New York Stock Exchange. And that was on top of ringing the closing bell at the CBOE that preceded that by 8 or 9 months. But those experiences, I say they're extremely humbling, because we didn't get there because of just because of he and I just came up with an idea. We got there because people, generally speaking, said yes to us when we told them about our idea and we shared with them our thinking. It was because they said yes, and we were able to actually prove what we thought. And we had that opportunity, that the culmination of all of that was, for example, ringing the bell or banging the gavel or whatever it is. But that experience, and when I'm talking to people and I say, oh yeah, you can go check out our video, and the whole attitude just shifts. It's the wildest thing, from being just a guy with an idea to suddenly, whoa. I mean, we're serious about what we do. We're committed to this. Even just the idea of going to a bell ringing and doing it, that, there's time and effort involved, but we're happy to do it. Elated to do it.
Yeah, but Bernard and I have known for a long time that this structure will hunt. We just knew it would hunt. It's just been a matter of having enough capital under our firm to be able to afford the carry. Being able to launch something that we know if it doesn't raise money in 6 months, that's not enough time. We have to be able to sustain this thing from let's say birth to adolescence. And what Bernard alluded to early on here is that we're really pleased. We thought we might be feeding this fund and subsidizing it for up to a year.
Ouch.
And we got to break even in 90 days.
Wow.
So for us, this is a tremendous, validation of the fact that the market both wants this and needs this product.
Yes.
And can improve the outcome for investors, particularly. I mean, it's not a panacea for investing, but it's awfully close, because if you're younger, you can just pile money into this thing and not worry about having a liquidity problem where suddenly 40% of your capital is gone. And if you're nearer retirement, same thing. Instead of stepping away from the equity engine and moving more and more of your money into bonds, the safety of bonds, and capping what potential return is, you can potentially keep that allocation to equities higher than you would have otherwise been able to achieve. And that'll ultimately, I'm confident, work out better over, say, a 15 or a 25, 30-year retirement horizon. It just has to. So that's what I think is interesting for us. And trust, oh my gosh, we're in a trust business. I mean, a lot of businesses are trust business, but I'm not sure I have to trust my plumber as much as I have to trust my attorney and my financial advisor and my CPA. So when we get that validation from the street that we are being vetted by independent people, so the ability for us to launch the idea already comes with the idea that it's going to be able to A, execute, B, that we're telling the truth, and C, that we have the capacity to do it long term, because they're Wall Street's not interested in doing something like this for 18 months. It's not what they want to do. So I think that's been a huge validation for us.
Yeah, well, I mean, speaking of Wall Street, I mean, you mentioned opening up a New York office. So is that bricks and mortar?
Yeah. Yep.
Okay.
Yep.
It's
And then the
going to be
San
in.
Diego office also has bricks and mortar then.
Oh, yes.
We do. Yes.
So
Well, or steel and drywall, but I'm not sure there's any bricks in this building.
Yeah.
it's metaphorically, Larry.
Yes,
Yeah.
right.
I mean, Larry, I can actually attest to the fact that there are no bricks in this building.
Okay.
No, but I mean, so that multi-part question when I was talking about trust, you mentioned remote employees and things like that. The bricks and mortar offices in your industry and mine, do you find that also lends itself to trust with a long-term client? I mean, it's one thing to say we've been 20 plus years in the business, we've got a publicly traded ETF. Welcome to my basement. Come in for
Yeah.
a client meeting, and I say that tongue in cheek, but there are many firms that are trying to operate that way, and I think they're cutting themselves short.
I would agree with that. I think it's the overall credibility that you want to project of yourself and your firm, and your seriousness and commitment to providing services and capabilities to your clientele. I've just you want to be able to, people want to see the people that they're talking to over the phone when they come in. Oh, you're so and so. I love seeing that personal connection. I think having a physical space is very, very important. It comes down to the simple thing. If I'm going to deal with an attorney who works out of his house, well, I'm going to deal with an attorney who has an office downtown with a support staff of X amount.
Mm-hmm.
All other factors being equal, I'm going to go with the guy downtown with the support staff. Then the guy who's working from his basement could be very good. I'm not saying he isn't. It's just, what if I call and he's out picking up his kids and I need something done? Who's going to take? It's just all of that stuff.
Well, perception
And
becomes reality, right?
Correct. Yep.
How many clients in this day and age are actually visiting a bricks and mortar office, though?
I mean, so Larry and I, we have two sides to our business.
Yes.
Yeah.
And we have a data point of one, since we have this one company that we know about.
Right.
So given that, I'll let Bernard answer.
Yeah. No, yeah, we like to see our clients at least, well, pre-COVID, we were meeting our clients in our office. Pretty much that was it. I mean, you come to the office, we'll meet, or there were some people who do phone interviews. Now, obviously, we're doing Zoom calls with people. People don't necessarily want to leave their home, 20 miles up the road, or some people do, like they want the outing. But whatever it is, we can make it available to them. If they want to come to the office, by all means, come to the office. If you want to do it Zoom it is. But they know we have an office. It's known to them.
That's the point, yeah.
And so there's no question in their mind about, I wonder how much longer Larry and Bernard are going to be working out of their basement for, or out of their garage, because basements aren't that common here in San Diego. That would be quite unusual, actually. But proverbial basement.
Sure.
So, we've never thought about not having an office. I think it's just part.
I had a client come in yesterday that I hadn't seen since before COVID in person, but we've had regular reviews by phone or by Teams. But we had a little bit more complex thing to go through, and they said, would you mind if we came in the office? I'm like, absolutely not. I mean, we have the office to have people in here, and we're happy to see them. But it's remarkable, Garrett, how many people have gone to just prefer, Teams meeting or a Zoom meeting is much preferable. They don't have to get in the car and take the time to come see us. So, but it's better. I like the body language. You can tell not just what's happening from the neck up, but the whole vibe, and see how things are going.
Well, they kind of also want to see that you're a real person, and they want to also, like, my staff will, I probably drive them crazy, but to me, professionalism, I prescribe to the weakest link theory, right? So if I have a professional office, but it's dirty, or the sign has a light bulb burnt out on the outside, or I show up and I'm in ripped jeans for a client meeting, like whatever it is, right? You can see I'm in my boardroom here. And yeah, I think if everything isn't there, all those little tiny things, the client starts to not trust you. And then maybe a phone call goes unanswered for a day, and all of a sudden there's another little doubt in their mind, and maybe an email takes a little bit longer than it should. But I find when the overall picture is that of absolute professionalism and trust, that's what I tell my staff, they give you a little bit of leeway, right? I don't know
Mhm.
if, would you agree with that?
Yeah, absolutely. I think that's important.
Yep. No, I completely 100% agree.
So let's just touch on something before a couple more questions, if you guys would. Like a lot of my audience are business owners. I have a big network, as I mentioned in the green room, of business owners that have just had large exits, and they're sitting on liquidity, right? Assuming that they're listening to this podcast, what would be your advice, maybe even to use your framework to protect capital without feeling like they're just sitting on the sidelines?
I mean, my first answer is call us, but
Shameless
but
plug.
no,
Of course.
yeah, no, I'm kidding. I mean, I'm kind of half kidding. Just do something where you can have absolute confidence that your life's work doesn't get eviscerated in an overnight event. So be intelligent about what you do with the money, and don't stuff it under a proverbial mattress.
Mhm.
I think that's a terrible decision. But you do intelligent things with it. Obviously, we love what we do in terms of the structure of what we've done. Other people are welcome to do it. You're welcome to duplicate whatever. It's all good, but you can't also ignore the ravages of inflation. So if you're going to take all of your money and just put it into just purely into government bonds and that's it, you're going backwards.
Yeah.
You're losing buying power. So
Well,
if it's
but
investing,
I would jump in and say, listen, if you have a liquidity event and your liquidity event is $200 million, and your lifestyle is $200,000 a year, then you're in a position where you don't have to take any risk if you want to. You can generate so much additional annual income from just the safety of short duration bonds that you're fine. So that it's really the question when your income needs are closer to what your capital can generate
Mhm.
is where you start to really need a professional or a serious look at what kind of risk you're taking in order to squeeze that extra juice. And that's the part where it gets very clear that you can't just be satisfied with meeting that requirement right now. You've got to have something that's going to generate rising income over time, or you'll end up going broke safely, which is
Mhm.
a terrible thing to do. You'll just lose purchasing power
Yeah.
slowly and
Just
slowly and
watch it
slowly and find
dwindle down.
yourself. Yes, exactly.
Okay. Second last question. Um, I always like to talk about the future when I have investment firms coming on. So, what are you looking at for the next 3 to 5 years? I mean, obviously, the last year and a half, 2 years, we've got this AI war going on out there, tokenization, new asset classes. Had a person on, I don't know, 3, 4 months ago talking about rare earth metals. Where do you see, if you could put a crystal ball on it, what are your predictions of what's going to be happening in the next 3 to 5 years?
Larry, do you want to get this one, and I'll come and follow you?
Yes, that'd be great.
Okay,
So
fine.
here's my thing. The short answer is we don't care. And here's what the reason I'm sort of flippant about this. This S&P 500 that we talked about earlier, it's comprised of the 500 largest companies by market capitalization. Whatever idea generates over the next whatever future time, if it's significant, it's going to get itself into the S&P 500. That's how it's going to land. And so my perspective is that sure, whether it's Nvidia and it's a technology company, or it's some other kind of shipping thing, or it's a space development, if it has significant capacity to raise capital and to become worthwhile, it will make itself into the S&P 500.
Mm-hmm.
And I'm already going to be an investor there. And so from my perspective, trying to spend that time to throw a dart, I'm just going to miss a lot. I think that's my view, and it's a worldview that I think shapes our firm. It could very well be that AI has a tremendous impact across not just the companies that manufacture AI, but the ability for that AI implementation to take a company that is number 462 and make it number 46,
Mm-hmm.
and that will drive tremendous performance in the S&P and across the board. Now, are there risks involved in that? Yes, I think there's an existential risk to the human race, frankly, about what to do with all the people that are put out of meaningful employment.
Mm-hmm.
Not kidding at all.
No.
Just like seriously, like what
Yeah.
do we do with people that were answering phones when we're already testing right now our own artificial intelligence for phone
We already
appointment
have one
setting.
running on our line, full
Right,
AI voice
exactly.
reception. Yeah.
And that would have been somebody not long ago. So there's a real thing there. But I would never attempt to put any significant amount of capital against that idea. Right? You can imagine some people might, right? And if they're correct, they could have a tremendous payoff, like putting, 20% of your net worth on not black or red, but on 16. Picking the number out of 40 or 50 or whatever's on a roulette wheel. If you're right, my God, the payoff is tremendous. But if you're wrong, which is more likely, then you lose the capital. So trying to do that when you're looking at individual things, in my opinion, whether it's AI or whatever is hot and interesting, the likelihood of success is limited. And as a result, there isn't an emphasis of capital allocation to the idea. So even if you're right, even if you pick the right thing, did you have the balls to make it meaningful to you?
Right. Mm-hmm. Did you put enough into it?
Right. Yep. Or does the idea have to be so good that it only takes $1 to return $1 million?
Or $1 billion or whatever.
Shiny objects, and you're just saying again, you built a system, it works, it's resilient. Why would you go and
correct.
You're confident that it will test.
One follow on too. Our ETF, as I said, is risk baked, right? We have the 15% allocation. Imagine if you have that person that has the $200 million exit, that doesn't have a huge income need, that has extra risk capacity. In the SMA space, we can build you a 20% floor and give you 30% more potential return. We can build you a 35% floor and give you 3x the return. So we're the opposite of conservative. If you want to be aggressive, we can be more aggressive than you can imagine. And what I emphasize with this is that if you're in a situation where you've got risk capacity, that additional option allocation is more volatile than Bitcoin. It routinely kicks the ass of Bitcoin. It would put NVIDIA to shame. Those two positions aren't volatile enough to keep up with what we need it to do to drive our portfolio. So, if you're looking for a visual and listening to me, Bernard and I come in here every day and we have spacesuits on with those big, like asbestos gloves, and we handle an extremely volatile asset class.
Right.
I mean, it's not even fair to call it volatile if you're comparing it to a stock. It moves orders of magnitude faster, and is the reason why most advisors and most firms don't use it, because it has the capacity to do amazing things if you're on the right side of the trade, and devastating things if you're on the wrong side of the trade. So that's the thing here. We can custom design in the SMA space a structure and a strategy that would, blow your mind, if your capacity for risk is blow your mindable.
Well, again, if that's what you're looking for, it's not.
Right.
We don't dictate that to someone. We want to understand what you're comfortable with.
Of course,
but
it's all about capacity.
So I'm just going to echo a little bit of what Larry had to say, which is we're very agnostic about what the future holds. I mean, I say it at the risk of, I don't want to sound flippant, but to some extent, we don't really care. It sounds very flippant to say that, and yet we're in the business of managing money, because to the point that we've made all along, it's the structure of what we have. We believe will perform when it needs to, and it'll do the defensive thing when that presents itself, and it will present itself. It will absolutely present itself at some point. We just don't know when. But we are, just the whole genesis of how we built this portfolio. Just to go back a little bit, personally, I've done a lot of reading about Warren Buffett and what he does, and his fear about nuclear is kind of the real threat that the world faces. And when we built this portfolio, we were thinking about, let's build something that is kind of nuclear bomb proof, that we try to envisage a horrible scenario using a nuclear device. And we didn't realize it's going to protect us from a financial crisis. It's going to protect us from a global epidemic. It's going to protect us from all manner of problems, because it has to do with the basic fundamental structure. So it's like, if you want to build a house and you decide you don't want to have any footings and you don't want to have a foundation, and you're going to build it in a floodplain, and it's going to, somehow you expect your house is going to stand. I got news for you. It ain't.
Mhm.
It'll stand for a while. And maybe you saved yourself a couple bucks putting your house on this squishy soil in a floodplain. But longer term, you're floating right down that river with every, when that big one hits. We built something that's got very solid foundation with unlimited upside. It's very, very happy. So that's my answer. We don't try and predict what the markets will do today, tomorrow, next week, next month, next year. Couldn't. It's just.
I love it. I love it. Okay. All right. Final question. And I have two guests today, not just one. So we'll let each of you answer. This is the Investing to Win podcast. How do you define success, and what does winning look like for you?
All right, Larry, I'll let you take this one first.
I'll go. So this one's personal for me. I think it was brought up with some coaching from a person that helped us a few years ago. And it involves my father, who happens to have been a victim of what turned out what morphed from a perfectly professional financial firm up in Northern California into a Ponzi scheme. And the guy who was at the head of this firm was about my dad's age, so middle to late 50s. My dad worked for this oil company for his whole career and then retired with a pension. And he was given the choice of getting a cash payout, which he took because he knew he could give it to a professional investor and do better than the institutional money. And within about 2.5 years, that whole arrangement had gone upside down. So my dad's early retirement and really significant financial windfall from working all those years overseas was lost. That process, frankly, destroyed him. It was the very happy, gregarious man that I knew isn't the man that we got the last 30 years of his life. Mm-hmm. It just destroyed him. So for each person out there, it doesn't have to be fraud. It can just be making an investment decision that gets away from them and they lose. And I don't know, each person has their own number, whether it's 15% or 20% or 28%, where they start to question themselves. Like they start to question whether or not they have the capacity to make the next decision. And when that confidence, the self-confidence is lost, the best response that person can experience is to no longer make those investments, no longer make those decisions. That is the worst decision. They don't realize it until it's too late, and they've had their money squirreled away in types of investments that aren't investments. They're like safety accounts and just savings. That destruction, that financial destruction that occurs is devastating to multi-generations, potentially. And I'd really like to see if I can help prevent that and provide a vehicle that allows for long-term wealth and success without the devastating impact of things we can't control. So that's really my vision of success, is that the reason we're reaching out to advisors now rather than just trying to secure more additional individual clients is that we can impact many, many more lives and many more people if we work through other advisors and help them understand what we're doing.
Yeah.
And that's what we're focusing on.
Bigger purpose is what you're talking about there, Larry.
Yeah, I mean,
I love that. I love that.
Yeah, for me, success is the ability to help try break this, what I call the cycle of poverty, where, a side project I have is to try and educate kids in very underprivileged. I'm from South Africa, so I've chosen that as my kind of go-to country to try and get kids who are in the townships there, good educations to try and break that cycle of poverty. And if I can get that number up to a meaningful number, that to me would be just super cool. Right now the number's small, but I've greater hopes for being able to do a lot more of that in the not too distant future. And that is, truly changing the trajectory for that cycle of poverty, which I think education is the only way out of that.
Well, that's a great place to stop, guys. I want to thank you both for coming on the show today. Wealth of information, and I learned lots. I know the audience is. So I will, after the show, I'll gather some information from you guys. I'll throw that into the show notes and allow people a way to get in touch with you.
Sounds good. Thank you, Garrett. It's been a pleasure.
Thank you, Garrett.
All right. Have a good one.